Hey, Zach. Hello, everybody. Good to see everybody again. We are focusing this month on Wise Counsel Live and really in many other ways on all things taxes. It's always a fun thing coming up to April 15th. Yay. All of our friends who are CPAs kind of disappear on us and we don't see them for a long time for good
Deep
reason.
in the weeds.
Yeah. So we thought, we would deal with taxes this whole month. And today we're going to be talking about a topic that I think at least the first part of it would be relevant to anybody, Zach, one of the first of 5 points we're going to touch on. But the bigger conversation today is designed for people who are either sole proprietors or maybe they own an LLC or a sub S corporation or a C corp. And we have these conversations often in our planning practice of what kind of retirement plan makes sense for me. And there's all kinds of different answers to that because it depends on the circumstances. So we're going to kind of walk through those today, and hopefully people will leave today's discussion with at least kind of an understanding of the kinds of circumstances where each of these plans might be really worth looking into in more detail. And at the end of the discussion today, we'll also talk about a deeper dive we're going to do into some of the more advanced concepts here in 2 weeks. But to start with, Zach, we sometimes, you've got a client, let's say a hypothetical situation where they technically have business income. Maybe they're a sole proprietor, for example. And they're making 20 or 30,000 a year, and they're thinking, well, I'd like to keep putting money into a retirement plan. I've retired from my career job where I did a 401k all those years. What are my options? And the thing a lot of times people overlook is just the most basic solution. So kind of explain a situation where you might see that type of person come in. And the best thing for them to do might just be a simple old regular IRA or a Roth account. Kind of speak to that first as we get started.
Yeah, if someone has a business or they want to contribute some money and save some taxes, they want to put it in a tax deferred account. The most basic 2 accounts out there as options are just a traditional IRA or a Roth IRA. And most people, regardless of your age, if you're having some earned income, or even if your spouse has earned income, you can put up to $6,000 a year into that for you as an individual. And you can actually do $7,000 if you're over age 50. And so if you have a lower income, or not even a lower income, but if you're making a lot, but you don't see yourself contributing that over that amount into an account, then it's, we're big fans of keeping things simple around here. And that would be the simplest option. Is just opening an IRA or a Roth IRA.
Yeah, exactly. So, it's always a good question to ask, well, how much were you thinking you wanted to save, right? Because that might save an hour of discussion explaining these other plans when, if you really only want to save $6,000 or $7,000 a year, well, let's just keep it simple, like you said. So good point. Now, let's say that same situation, somebody comes in and maybe we see this from time to time. Typical might look like maybe you're doing consulting. And so it's not a huge amount of money, but maybe it's $20,000, $25,000 a year of additional income after you've retired from your main gig. And they really don't need that money at all. So they want to save as much as they can, right? Of that into a tax deductible plan. All of a sudden, another tool starts to look more interesting then, right?
Right.
Talk about the simple IRA and how that might work in a situation like that, where they want to save more than they could normally put into a regular IRA.
Yeah, a simple IRA can be a good option for someone who has some self-employed income. Maybe somebody's an author and they have $20,000 or dollars a year or something that they've made, and they're saying, hey, we really don't need this money. So where can I put it so that it can help me with some taxes? I don't want to pay, taxes on that. I don't need it. Let's put it away into an account. And that's where the simple IRA can be useful for somebody that wants to go over that, $6,000 or $7,000 amount we mentioned earlier, but maybe their income's about 20,000 or so. And the reason the simple IRA is good is because there's no percentage of your salary that limits it. As long as if you have 10,000 income, you can put 10,000 into that simple. If you have 13,000, you can put 13,000. Now, eventually there is a limit, and you bump up against that limit. The IRS says you can only put so much in there. But if you're in that sub 50,000 income range and you want to put money into an account, the simple can be a good option for you there. If you get over that 50,000 amount, you get up into the 60s or mid 60s, and there's another account type that actually will allow you to add more.
Yeah, we'll get into that next, but I want to camp a little bit more on this simple plan, just so people kind of understand this. We could see somebody, for example, who has $20,000 of income, and they're filing it on their regular tax return. Let's say it's a Schedule C, sole proprietorship. And if they don't need that money, they could put in, and they're over 50, right? And that would typically be the case because if they're already retired from their other job, they're usually going to be over 50. So they could put in right off the bat, 13,000 tax deductible, plus the $3,000 catch up, which is 16,000 now. And there's also the ability to do a 3% match. So what's 3% of 20,000 would be another $600, right?
Right. So, yeah. 16.5 this year. They just upped it.
Okay. So 16.5 plus another $600. So in that situation, if they set the simple plan up early enough, and we'll talk on that in a second before we move on, they could put in like 80 or 90% of that 20,000 could be a full tax deduction by using the simple plan. So generally, when we're looking at this as planners and we have people come in with different circumstances, if we see somebody who is in, like you said, maybe their self-employment income is less than 50,000 and they want to save as much as possible, this is one of the go-to strategies we think usually is worth taking a look at.
Yeah. Yeah.
Now, one of the traps, talk about the trap people often run into, because usually when they're thinking about this, they're thinking when they're getting ready to file their taxes, right?
Right. Right. Yeah. The trap is that, we're in February, right? Right now, a lot of you are doing your taxes for 20 last year, and you're saying, okay, well, I know how much I made last year. I know how much I need, how much extra I have. That's behind me. I'm ready to say, well, let's open an account. The downside of the simple is that you can't open it post calendar year. So you have to open that up. Actually, for a simple, it's prior to calendar year end.
October 1st, I believe, is the deadline.
Right. It's October 1st. So it's one of those things.
That's only a problem. That's only a problem in that first year, right? That's after that, you just a regular tax filing deadline. But that's why it isn't used nearly as often, because a lot of times people don't really think about this until they're filing their taxes and it's too late. And so they end up doing the next one we're going to talk about. And you alluded to it earlier. Let's talk about the much more popular and common SEP plan. When does that tend to show up? And when, in our opinion, if you're being proactive, when is it really one of the better options to consider?
Yeah, so the SEP tends to show up during time periods like now. Usually from January 1st to April 15th, when most of you are doing your taxes. If you tell your accountant, hey, I want to put some money in something, for many years now, the only type of account that you could open and fund after the calendar year had ended was called an SEP, a simplified employee pension. And that type of account would allow you to add money for the previous year, even though you opened it, post calendar year. With that type of account, depending on what kind of business you have, maybe you're a C corporation, you can do 25% of whatever your income is. But if you're just a sole proprietor, you're making some money on the side like that author, then you can do, it works out to about 20%. And so if you did make, you know, if you made 20,000 and you hadn't remembered to set up the simple account, so you can't do that 16.5, but you could set up an SEP for last year. You can do the 20%. So in that case, you know, you've made 20,000, you could only do up to 4,000 into that account. So you can see there's that trap. You can't save quite as much if you think about it after the year's over.
Yeah. So once you get up to maybe the 50,000 income range, then you start leaning more towards, on a proactive basis, towards looking at the SEP plan for a really simple situation. We won't get into the weeds too much today on how employees factor into all of this, because usually when we see these smaller plans, it's typically you know, sole proprietor, maybe a husband and wife, maybe they've got one or two employees. I mean, IRS kind of created these plan options to make it easier for small businesses to set up retirement plans without all of the extra fees and regulation and everything. So those are the simplest plans, the easiest plans to relate to. Now, when you get into a situation where you've got businesses that are, maybe you're not retired, this is how you pay the bills, this is your main gig, but you've gotten through that part of life, maybe where the kids are raised, and you've got your business is generating a lot of excess cash flow now, maybe for the first time, you know, in your adult life, you feel like, wow, we actually have money. What do we do with it? And this alarm bell is going off in your head that I'm not getting any younger. I really need to start ramping up my retirement plan here. Now we get into another set of tools. And I'll just tell everybody up front, we're going to be doing a much deeper dive on these last two we're going to touch on today. In 2 weeks, we've got a specialist coming on with a third-party administration firm that we have a lot of confidence in, and we're going to be going into a lot more detail on that. I think that today, though, we want to at least touch on it. And what we're talking about are plans called solo 401k plans with a combination of a profit-sharing plan. That's one. And the other is, the industry, we call it a defined benefit pension plan, but the one we're particularly talking about today is called a cash balance plan. So why don't we take them each separately, Zach, and then we'll talk about how they can also be combined, and just give a kind of a general working understanding of these. Why don't you start with the solo 401k, kind of explain for a company making, you know, pretty good money, they don't have a lot of employees, maybe, let's just keep it simple. Let's say it's a husband and a wife and no employees. Kind of break down how a solo 401k might make sense for them.
Yeah, it can make sense if you're, you know, if you're earning maybe 100,000 or a little bit less than that, or, you know, maybe slightly more. The solo 401k can really allow you to contribute a lot. There's even an argument that if you were had income that was anything over, you know, that mid 50,000, and you expected that to continue, could definitely make an argument to open a solo 401k. Reason is because if you're over age 50, you can put up to $64,500 a year into a solo 401k. And there's a couple different components to get to that 64. One of them is you can do up to, if you're over age 50, you can do 26,000 a year, just as employee contribution. So even if you made as little as 30,000, you open a solo 401k, you could put in 26 immediately, just as the employee. And then there's an additional component, which is similar to that number we mentioned earlier, where it's 20 or 25%, however much your income is. And so you can really maximize the savings into the solo 401k. If you're in that 50 to 100,000 range, I think it certainly makes sense. But the cool thing about it is the IRS has decreased the burden. There are some extra forms, but there's our firm and some specialists that we partner with have really simplified things and, brought the cost down to where if you're in that price range, you really want to maximize your savings. There's definitely an argument to use that over an SEP a lot of times.
Yeah, so a situation might look like, let's put some numbers to it. Let's say you've got a husband and a wife running a business, and they're making a couple $100,000 a year, of compensation coming back to them. Maybe when you first meet them, they're paying all the salary that it takes to meet the household needs. They're paying that all through the wife. Let's say that she's, I don't know, let's make what would be a good profession, maybe she's a consultant, and she's got a long history of really generating a lot of consulting income, and it's very stable. And yet the husband might be doing the books and kind of keeping QuickBooks and taking the biggest part of the load on the tax filing and whatnot, but he's never taken a salary from the business. And so in a situation like that, we might say, well, look, you can still take the $200,000 a year you've been paying to your wife, but maybe we split that. $30,000 is now going to be going to the husband as a bookkeeper salary or a CFO or whatever you want to call it, and 170 is going to the spouse who's doing most of the work on the revenue side. So they're still bringing in 200,000, but what that allows them to do now with a solo 401k is that they can each do the 26,000 you mentioned earlier. So that's already 52,000 tax deductible right off the top.
Right.
And this profit sharing component that is kind of melded in with the solo 401k structure allows them to do essentially about another 25% of compensation, right? So what is that? Maybe another 50,000 between the two of them. So they've gone from, in our first three plans, with IRAs, they could have done maybe 14,000. With Simple Plan, they could have done maybe, 30,000. With SEP, they maybe could have done 50,000. Now all of a sudden they're snipping 100,000 a year that they can put in pre-tax just with the solo 401k plan. So, obviously all the circumstances have to make sense. But one of the other nice things about that plan structure is that it's flexible. They don't have to put that in every year. They have the option of maxing it out, but they don't have to.
Yeah, you can put in zero, or you can, in that case you just described, you'd have the 52 plus you'd be putting in over 100, just over 100,000 for that couple.
Right. So, what we're trying to do here, guys, as we unpack this, is we're trying to show you, kind of starting with most basic IRA and then going up to maybe simple plans and then SEP plans and now solo 401k. It all comes back to the circumstances. What are the ages? How many employees are there? How much do you really want to save? And based on those kinds of variables, you can go back and say which of these plans make the most sense. The last one we're going to touch on, Zach, is probably the least understood one out there. It's because you don't hear much about it. And it is what we talked about earlier, the cash balance plan. Most people are familiar. I find it helpful to explain it this way. Most people, if you're old enough, if you're in your 60s or 70s, you remember the days when there used to be pension plans for everybody. Today, you see it mostly with government, federal employees, teachers, that kind of thing. It's kind of being phased out. But the idea behind a pension plan traditionally, what we call in the industry a defined benefit plan, was that you were defining the benefit that based on your years of service and your salary and your age and your retirement age, actuarial worker bees were out there crunching the numbers, and the company you worked for was funding this pot of dollars and managing it to where when you got to that retirement age, they were going to pay you a monthly income for the rest of your life. And then at death, it stopped. So that was a traditional defined benefit plan. But some years ago, IRS allowed kind of a variation of that. It's still calculated the same way, but instead of funding now for a monthly pension benefit, you get this big piece of, or this big account of money. It's a single cash balance at the end when you retire, and it's not a monthly income, it's a cash balance. And you can take that when you retire and roll it into an IRA, whatever. And so it just becomes a super funded way to get a lot of money into an IRA. Now, where it gets really interesting as planners, when we meet people who have the right circumstances, is let's say we go back to that example of a hypothetical husband and wife who've got a business, but let's say this business is really come into some high cash flow years. Maybe they're, instead of 200,000 a year, maybe the wife in this case got some big contracts, and over the next 3 to 5 years, they feel very confident they're going to maybe bring 500,000 a year in, or maybe $1 million a year in. It's just not their normal cash flow. And they're thinking, well, what do I do with all this money? And at the same time, they're older, maybe they're in their upper 50s or even mid 60s. And so that is where the cash balance plan can be extremely powerful, because they're older, their salaries can be adjusted because they own the company, and they can set the retirement date to be as near as 5 years. And so the actuaries will go in and do their thing, and they can really kind of customize the plan to give the company plan sponsor, which is the husband and wife in this case, exactly the amount of contribution level they feel comfortable with. So they might be able to do, 100, 150,000 a year just into that cash balance plan. But then they could also do the solo 401k. And so all of a sudden now, whereas before with the solo 401k, our numbers were saying, well, maybe you could put in about 100,000 a year. Now they might be able to structure the combined plans to where they could do 200, 300. We've seen even situations in the past where it was more than that. Again, it always comes down to the circumstances, but you are talking about contributions going into this plan now that are fully 100% tax deductible. And, within 3-4 years, if you're ready to retire, you can shut the plans down, roll that money out into an IRA. So that can really be a way to catch up on retirement savings very quickly for people in that kind of a situation. Yeah.
And those last two that we've been talking about, that solo 401k and profit sharing, and the cash balance plan. That cash balance plan, certainly if you're older and you have higher income, it's just because of the life expectancy factor there, it's going to allow you to just really juice some money into those savings. But particularly the solo 401k, or both these plans work for younger individuals too. I would say that one of the things, maybe there's someone who's a young doctor, or they have a business that they've started, and they just, they live a modest lifestyle and they want to save a lot. They can, for younger folk, they're saying, oh, I'm making too much to put money into a Roth account. The IRS won't allow me to do it. Well, for them, there's actually a strategy. We can open a solo 401k for them, and they can put tens of thousands of dollars, talking, near that 64,000 amount potentially, into a Roth, to where maybe they're not saving tax today, but they're saying, hey, I'm going to have this money. I'm not going to need it for 40 years. Tax rates are going to go up.
Yeah.
We can help them to basically super fund a Roth when, outside of them being self-employed, the IRS says they wouldn't be able to put $1 into a Roth. So
yeah, that is
really cool strategy.
That is a great point. I mean, even if they could fund a Roth, all they could do would be $6,000 each if you assume they're both under age 50. But usually a situation like you're talking about, they're making too much money to even be eligible to do a Roth. And so they just assume they can't do it. Well, wait a minute. Maybe you can if you happen to be self-employed, or at least some of your income is qualified as self-employed. And then now you're back into those 401k limits again on what can be put into a Roth account inside that 401k plan.
Right.
Now, that's a great point. I'm glad you mentioned that, because a lot of times we work with so many people who are getting ready to retire or already retired. A lot of times I tend to go with the examples of people who are at that stage of life, but we certainly see the other side of it as well with people who are wealth builders right now in earlier career stages. These tools can be very powerful for them as well. Well, Zach, I think we've accomplished what we wanted to today. We've kind of done a quick overview on the 5 most common plans we see. I'll say again, in 2 weeks, we're going to have a guy named James Pender, who is actually based out of Austin. And their company is one of the larger providers in these custom retirement plan spaces. And we thought it would be helpful to do an even more in-depth discussion and explanation of these solo 401k plans and cash balance plans. And so we're going to let James come on and do the heavy lifting on that in 2 weeks. In the meantime, we'll just say, Zach, I don't know if you want to share that image of that flow chart. We have a little tool. If any of you watching this are interested in this, all you got to do is ask us. We'll email it to you. I'm not seeing it, Zach. I see a black screen. I don't know if it showed up or not. Oh, there it is. There it is. Basically, it's just one of these flow charts where, it asks a question and the answer is yes or no, and then it kind of walks you through the logical conclusion of what you might want to pay more attention to. We've kind of just done that in I think a lot easier to understand discussion, but we can email this out to folks if they request. All they got to do is either call us or send us an email. We'll be happy to send it out.
Yeah.
Otherwise, Zach, we're done. You got any final thoughts? Anything you want to say?
No, not looking forward to having James on the next Wise Counsel Live, but that's pretty much it today.
All right, everybody. Well, I hope you go out and enjoy this beautiful weather we're having. It's a lot better than what we were seeing a couple of weeks ago. That's for sure. Thanks, Zach. We'll see everybody here in a couple of weeks. Have a great day. Bye-bye.